If there's one thing that most of us can agree on, it's that paying taxes is rough. I mean, sure, we're happy with what we get for them, but it's frustrating to lose that chunk of income, especially when it comes from a profitable rental property. If you're just getting started with renting out your property, taxes can be confusing, but that's why we made this video. It covers everything you need to know about how rental income taxes work, including some tips for reducing the amount that you owe. So with that said, let's get into it. But before we do, just keep in mind we're not attorneys or financial professionals. So although we'll guide you as best we can, we do advise you to reach out to a professional if you need personalized advice. So, first thing you need to know is that rental income is taxed like ordinary income that you generate from any 9-to-5 job or personal business. So, if you're in a 25% tax bracket and generate $50,000 per year in rental income, then you pay $12,500. Pretty easy, right? Now, while it may be easy to understand, it's not easy to pay $12,500, of course. That being said, deductions are much different for rental income than they are for standard jobs. There are dozens of deduction methods for lowering your tax burden, which we'll talk about later in this video. For now though, it's enough to know that these exist and that rental income deductions work more like business income than personal earnings. Now that we know how rental income is taxed, let's take a closer look at what actually qualifies as rental income. According to the IRS, rental income is any payment you receive for use or occupation of a property. The key thing to know about this is that rental income encompasses more than just monthly rent you receive from tenants. In addition to monthly rent payments, rental income can also include advance rent payments, any portion of a security deposit that you don't get back to the tenant services, such as maintenance costs that tenants pay for themselves, and canceled lease payments, such as early termination fees. If you receive any money during the year in any of these categories, then it needs to be reported to the IRS as part of your overall rental income. So unless you've got some weird interest in being audited, it's important to keep great records for all of this. So at this point, you know what rental income is and how it's taxed. Now we can get started into the good stuff, how to save money. Here are 4 strategies you can use to reduce your rental income tax throughout your financial year. The first thing you should do is make sure that you're taking full advantage of all potential tax reductions for rental income. This is a list that includes property tax, home insurance premiums, repair and maintenance expenses, and other costs of operating, including utilities, interest, and advertising. One thing to note here is that you're usually not allowed to deduct the cost of property improvements, as the IRS doesn't consider these repair or maintenance requests. So if you're making home improvements to the home rather than repairs, you may be out of luck when it comes to tax reductions. Speaking of tax deductions, this one's important enough to deserve its own shout out. It's called depreciation, and it's a bit complicated, so stick with me. When you purchase a new residential or commercial property, it's expected to last a certain number of years. For residential units, that's 27.5 years, while for commercial properties, it's 39 years. Thanks to our friend Depreciation, you're able to deduct the percentage of the property's value from your rental income taxes every year. Now, in order to calculate this, you take the cost of acquiring the property and subtract the value of the land. Then you divide that figure by the 27.5 to figure out your deduction amount for the year. For example, let's say your property is worth $500,000 and the value of the land alone would be $75,000. To calculate the depreciation, you would subtract the land value to get $425,000 and then divide that by 27.5%, which equals $15,454. That is your total depreciation deduction. Now that you have that number, you would then subtract the $15,454 from your total rental income of the year and pay taxes on that figure instead of the total rental income figure. So if you made $170,000 in rental income, you'd pay taxes on $154,546 of that, which could save you around $4,000 in taxes a year. Are you still with me? I know that was a little bit complicated, but it's important enough to spend time on it given how much you can save. You also may have a qualified business income deduction, or QBI, that you can use. It allows you to deduct up to 20% of your pass-through business income. This refers to any income that's generated from a pass-through entity, like an investment property. However, the income threshold limit is $163,000 for individual taxpayers and $326,000 for married ones. Now, this is another tax deduction that can get pretty complicated, but you may be able to claim a partial deduction even if you exceed the income threshold. So in this case, you may want to contact a tax professional if you need some guidance. Now, before we get to the last section on our list, if you've enjoyed the video so far, don't forget to like and subscribe as it really helps us out. All right, let's get into it. This next tip is a preemptive tax saving strategy that may apply to your situation. It's called a 1031 exchange. A 1031 exchange is a method of exchanging like-kind properties to defer capital gains tax indefinitely. Basically, when you're selling a property to purchase a new one, you can avoid having to pay capital gains taxes as long as you finalize the purchase of the new property within 180 days of selling the old one. Honestly, this one is a little complicated too, thanks to the IRS. So you may want to do further research if you think it applies. At any rate, it's worth keeping the 1031 exchange in mind if you ever plan on selling one rental property for another. So that about wraps things up. We hope this video wasn't too hard to follow along with. Now, we did cover some pretty dense topics here, but one last thing that I want to tell you is that when it comes to rental income taxes, you really need to keep good records. There are so many different possible deductions to consider, and if you're audited, you'd have to produce the full bookkeeping for each of your rental units. That can be tough to do without the right system. It's why we designed DoorLoop to make financial reporting easier for landlords. Our all-in-one property management software keeps track of all of this so you don't have to worry about doing it yourself. It even integrates with popular online platforms like QuickBooks. Plus, it can handle everything from tenant screenings and marketing your rental unit vacancies to streamlining maintenance requests. So if you want to learn more, you can sign up for a free demo on our website at doorloop.com. But whatever you decide to do, we hope you found this video helpful. Don't forget to like and subscribe to see more videos just like this. We'll see you soon. Until next time.